All right, my friends, we're now going to jump into financial statement analysis, a very critical tool for management to understand how things are going and where they may be headed unless we ultimately do something. Now, it may be a positive. They're heading very well, and we want to make sure they continue. Or maybe there's a downturn, and we need to make some adjustments in order to modify our approach. But in any case, what we're going to do is we're going to look at two fundamental ways analyzing organization's performance: the vertical analysis and the horizontal analysis. Now, the vertical analysis is literally taking every line in the income statement and every line in the balance sheet and literally giving it a percentage. So you're looking at each line and seeing how you're doing. And by the way, this is also known as common size financials. So it can be done on the income statement and it can be done on the balance sheet. What you do is you have a denominator, and that denominator is going to be, for the income statement, total sales revenue. So you want to use that number. And then what percentage is every single line item below it? For the balance sheet, you're going to take total assets. Now, obviously, you say, well, why don't you use equity? Well, liabilities and equity aggregate up to assets. So that's the big number. So you take that as your denominator, and then what is cash as a percentage of total? What is receivables as a percentage of total assets? What about inventory? What about current accounts payable? Long-term debt, common stock, APIC, retained earnings. You can do it for each one. This allows you to compare both your company and other companies that may be larger or smaller in your industry. It also allows you to use it for your divisions. You may have one very large division and one that's coming and growing, and you want to compare to see how those two management teams are operating. And therefore, it gives you a little bit more of an equal playing field to do this. It's used to calculate the growth rate or possibly the reduction rate in the business model. So on the income statement, we're going to use net sales revenue. Notice that's going to be the denominator, and then you're going to take each one of the income statement lines, each one separately, and say what percentage of the net sales revenue is it? That's the fundamentals. Here's a simple example. Have an organization has the opportunity to invest either in an established restaurant in big city or in a local restaurant in a local city. All right, so you have the big one and you have the local one. Now, you can see they're radically different in size. One has $1 million, one only has 40,000. One made 50,000, the other made 6. How can you compare two companies that are so radically different? Well, what we do is we say, obviously, sales is 100% of sales. Cost of goods sold in this case was 50%. Operating expenses were 45%, and therefore net income was 5% of the sales revenue. Now, for the small company, we're going to take sales divided by sales is 100. Cost of goods sold was only 25% of sales. Then we have operating expenses was 60%, and net income was 15%. You can see that in this case, on gross profit margin, the smaller entity is doing substantially better. But no surprise, operating expenses, the small company didn't have the economy of scale. So therefore, obviously, they had to spend more in operating than the larger big company would. So that's part of the focus that you'd want to look at when you're looking at these. And this is a simple example. You can imagine when you've got a detailed income statement and you can look at every line item to make an assessment between your company and another, depending on size, it doesn't matter, or between one of your divisions and another division in your own company that are different sizes. Well, the balance sheet works in similar manner. What you do is you use your total assets as the denominator, and then each line item is separately brought in and compared to the total assets and determining what percentage it is. Let's see how that would work. By the way, we'll take a look and show you how this could be really useful. Apex's management has set targets for their balance sheet accounts. They want cash to be 5%. Not too much more, that's idle cash, not too much less, and it's a problem with liquidity. PP&E, they want to invest in property, plant, and equipment, 50%, and they don't want current liabilities to be greater than 10%. So here's what we have. We have the Apex company's balance sheet. You'll notice what we're going to do is we're going to now break it out into percentages. So what percentage is cash of total assets? What percentage is receivables of total assets? So 50 divided by 410 equals 12.2. 80,000 of receivables divided by 410,000 is 19.5%. And inventory, 160,000 divided by total assets of 410 happens to be 39%. You can get the idea that we do each of these items so that now we've created percentages. But let's go one step further. When we look at them, we remember that the target for cash was 5%. Well, we wound up with 12.2. Maybe a little bit too much idle cash, not literally getting as much of a return by leaving it in a non-interest-bearing bank account. You'll note also in this particular case, PP&E is supposed to be 50%. We need that PP&E to generate assets or generate inventory that we can sell and make a profit. And yet we only have 29.3%. Maybe it's old inventory, it's been depreciated, or maybe it's just we haven't put enough investment in current items. And then look at liabilities. You have your target right here was 10%. And in this particular case, you are at 39%. So you're literally carrying a lot of debt. So here, one of the decisions the management may want to make is obviously cash is too much. We want to maybe utilize some of it in investing in our PP&E so that we can expand our growth product. And finally, we may want to take some of the excess cash and we may choose to use it to pay down on those liabilities. That's the vertical approach. Now let's take a look at horizontal. This goes across the horizon. What you're going to do in this case is look at one period compared to the next period compared to the next period. So this is an analysis over time, as opposed to comparing this to that at this moment in time, which is your vertical. Horizontal is looking more at the horizon. How are we now? Where have we gone? Where do we expect to be going? Notice you review changes in targets on your income statement, and you review growth or reductions in your balance sheet accounts. So once again, you're going to take a look and take your new income item, and you'll compare it to a base. Here we go with creating the percentages. Notice it's not it's on each item, but it's comparing it to a base year, which is your first year. Now, when we're looking at this, you can see that we had year one, and I'll just look at net sales, 1.3, and it grew to 1.8. That was a nice $500,000 growth. That happens to represent a significant growth. Then 1.8, it only grew by 300,000, not nearly as much in the second year. So if you look to the right, you can see when you compare year one to year two, you can see the growth. 100% would be exactly the same. 138%, 0.46, equals the percentage it did grow by. And then year one to year three's growth would ultimately be used. So you can see when you do the comparison, you can see, yeah, we've grown, but we didn't grow as quickly from year two to year three as we had from year one to year two. Obviously, you want to assess trends. You want to understand why certain things happen in the way they did. Illustrate that a little bit more. Look at growth rates, determining positive and negative growth rates. We take a look at a line item. Currently, that's your numerator, and we compare it to the denominator, the old line. Let's show you how that works. A little bit more specific here. Notice the same information, exactly the same information. But now we're going to look at year one to year two was a 38% growth. I'm going to round it to the nearest percentage. Year two to year three was only 16%. You notice before we showed this as 167 versus 138. I like this part of the approach better because I get a better feel for what the growth in incremental periods are. You'll notice when you look at cost of goods sold, in this particular case, from year one to year two, it grew by 36%. From year two to year three, it grew by 15.83%. So you can see profit margins are shrinking as a percentage in this particular case. And the bottom line is, if you notice over on the far right, you can see when it comes to net income, there was slower growth rate from year one to two than there was from year two to three. Slower in years 2 to 3. Now, one question that I'd like to point out to you, just in case the exam does a nasty thing and says, well, we know that your cost of goods sold was 1.2 million in year two. Can you tell us without us giving you the information, what was year one's cost of goods sold if year two grew by 36.36%. All you do is divide. You'll notice 1.2 million, the number they did give you, divided by the growth rate, which that they did tell you, and you can back into what the cost of goods sold was in year one. Small little trick, again, just in case they ask that kind of a question. Now you can look at your income statement and make the same assessment. You can see that cash went from 50 to 80. That's a 60% increase. Then it went from 80 to 100. That's a 20% increase. And by the way, you can do that with each line item, and that's how we got the percentages there. And you'll notice also, when you look down below, I just want to point out accounts payable and notes payable. You can see that in this case, we went from a negative to a positive in 1 year. And then all that was in accounts payable, where they went down and then went up. And then with notes payable, they went up from 40%, and then they continued to grow. They went up, but they went up still again. That's your cushion for liquidity. In this particular case, evaluation of growth rate, this reveals nuances that you want to be aware of. Profit grew, but it slowed down. And maybe that explains why, since there was a reduction of sales growth, inventory increased so much. And because inventory increased, it's now our cost. We're tying our money up. We may have an issue with liquidity. So maybe we increased our long-term borrowing with the notes payable and our short-term accounts payable. We spread them out a little bit longer. Those are some of the fundamentals that this can give you when you look over your financial statement analysis. All right, we're ready to move on.